Oops. Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 2, episode 37, and it's going to be part 2 of season 2's lease options portion. And today I want to walk you guys through the structure of a lease options. And in the interest of what we're talking about, I just want to make sure that we set the parameters very, very clearly. Number one, we are using single family homes as our example, and this is used as an exit strategy because as some of you guys probably already have heard of, is that lease options can also be used as an acquisition strategy. And so for some of you, if you haven't haven't seen the season 1 episodes, I just want to put it out here again. The way we look at it is that typically speaking, there are 3 general phases in every single deal that we do. So there's the acquisition stage, and then you have the holding and cash flowing stage, and then you have the exit strategy stage. So in this particular case, we use it as an exit strategy, meaning at some point we already know that we're going to be selling it to the end buyer there. And in between though, while we're hanging on to it, there needs to be cash flow. And some of you guys, if you're thinking about doing some renovations, definitely this is usually counted in the acquisition stage. Now, in this particular case, aside from the fact that we're leveraging single family homes as an example, and so single family homes usually are your single family detached, or sometimes depending on the markets that you are in, maybe attached property or shared wall property. So depending on where you are, because of the price point, it makes it a lot easier for you and your clients, your tenant buyers to get into. You might have to go into it. However, just remember, we do not endorse buying condos. So really, bottom line is anything that has a condo board involved, or if you're in British Columbia, in Canada, we call them strata. So just want to lay down some of that foundation first. And what we're going to go into is making sure that this idea of lease with the option to purchase is very, very clear to everybody, okay? So lease with the option to purchase by definition just means that this is why we call it lease options. And even though the street name is rent to own, at the end of the day, I like to stick to the technical terms simply because the fact that this automatically gives you the idea that this is a 2-contract process. Okay, so what that really means, ooh, my ESL is coming out here. So the 2-contract process, you have a lease agreement with your tenant buyer. At the same time, you also set up an option to purchase agreement as well. And the option to purchase agreement is super, super important simply because of the fact that this is what you will be helping your tenant buyer present to their future lender so that they are able to obtain financing to buy you out and become the homeowner on title of the property. Now, in this particular case, what do we include in the option to purchase contract? There are a lot of different clauses. However, we're going to focus on the deal structure and the analysis today. So what that really means is there are a few necessary components that you have to put in there. So first thing first is duration. So what that really means is the end date or the deadline to exercise the option to purchase. Exercise the option to purchase. And the second point here is that there needs to be a predetermined sale price. Okay, there needs to be a predetermined sale price. And last but not least, this is actually not seen as an agreement for sale, okay? It's not an agreement to buy, it's not an agreement for anything, it's an option, okay? So very much like the fact that, let's say, if you've had the experience of leasing a vehicle, by the time you actually drive that car off the lot, you already know how much your monthly payment is going to be. So what that means is that option payments and the amounts are predetermined as well. And then you know exactly how long it's going to be, how many payments you're going to make, and by the end of your lease term, excuse me, by the end of your lease term, what your buyout amount is. Now, unlike a car typically is a depreciating asset, properties typically are appreciating assets. So what that typically means now is, say if you're in a market where the property that you buy today is worth $400,000, what that means is fair market rent on that is probably, let's say, $2,400 a month. And you're in a market where there is, let's say, 3% natural or passive appreciation. So that's just your regular market appreciation. Usually we do a 5 to 10 year average, okay? We take a 5 to 10 year average there. So what that really means is, well, I don't have my calculator with me right now, is you would take 400,000 and you multiply it by 1.03, 1.03, and 1.03. So 3 times, that means this is now a 3-year structure. So as you can see, this is how we actually set it up. These are the 3 criteria that must, the minimum criteria that must be included in your option to purchase contract. Now, coming back to looking at the numbers now, okay? So what we're going to do is, let me see if I can find my calculators here. So I'm gonna bring up my calculators, then we can keep moving on this one. Or if I can get some help here. Almost failed there, not great. Okay, found a calculator, all good. So what we're going to do is, once we take 400,000 and we multiply it by 1.03, 1.03, 1.03. So what that means now is the option to purchase price at the end of 3 years term is 437,000. I'm just going to round it down by about $90 here. Okay, just gonna round it down by about $90 here. And so $437,000. Typically speaking, what we really want to do is to be able to help the tenant buyers. Remember yesterday we talked about, or the last episode we talked about, is about income, income, credit, and down payment. So we're either helping our tenant buyer to fix either one or multiple of these factors. And to be frank, when I say multiple, I usually just mean number 2 and number 3, because they need to have their regular jobs, meaning that they need to be able to prove income. And there's a whole other section that's on that. So maybe we'll go into speaking to lending rules later on as well. However, I want to focus on credit and down payment. So during the 3-year period that we're working with them, one of our goals is to make sure that, as mentioned yesterday, we ideally get them up to 680. This is a business decision that you can make. You can decide that you want to bring them up to 620 or above. And this now comes back to the fact that you need to be able to work with your mortgage broker to make sure that at 620, there are still options for them. However, I'm just going to say, you know what, let's play a little safe. We're going to aim for 680. And it's actually not that hard to get your credit score up to 680 now. And if you haven't caught up on the credit portion from last week's episodes, make sure you go back and watch those as well. Now, the most important part about this, though, is for most people that we're helping becoming homeowners would be literally the down payment portion. And these days, simply because the fact that tenant buyers, by definition, they're buying a principal residence. So I'm just going to use Canadian lending rules as our example here. You can feel free to tweak it to your local lending rules as well. So in Canada, the government says that in order for you to buy your principal residence, so the house that you're going to be living in yourself, and it basically requires you to come up with minimum of 5% down payment when you buy it. Now, we don't want to do that. We want to make sure that when the tenant buyers are ready, they have more than 5%. Why? Because we want to create some buffers, because nobody's got a crystal ball to say if the lending rules will change, if the government is going to change the regulations as well. So a lot of the times we actually suggest, and we ourselves use a minimum of 10%. Now, in the last episode, I also mentioned who we can actually help with this strategy. And one of those groups of people who are very, very good tenant buyers are typically self-employed folks. And when it comes to self-employed folks, most lenders, actually all lenders now at this point, want to see 10% minimum or more when they're buying their principal residence. So let's just use that as a baseline. So 10% now in this case against the purchase price of $437,000 works out to be $43,700. So this amount is what we would now call the total option consideration money, the total option consideration, okay? So total option consideration because it's an option to purchase contract. So what that really means is that this amount is determined here now in terms of how much they're going to have to come up with by the end of the term. And so once again, when they come into the program, we want to make sure that they are also committed, meaning they need to have some skin in the game. And more importantly, who does not realize that in order for you to buy a property that you want to live in, you probably want to be stashing some money away, meaning you want to have some savings so that it's not usually a zero down scenario. I understand that there are companies out there, they've made the business decision that they will take on tenant buyers when they have no skin in the game. That's their business decisions. You can make your own as well. We've made our own too. And in this case, I'm just going to use $15,000 as our baseline. And this is the savings that they will come in with. And now in this particular scenario, we call it the initial option consideration. So what that means now ultimately is there is a shortfall of $28,700. And guess how long they have to accumulate that money? They have 36 months to do that. So let's do this, 28,700 divided by 36 months. We have 797.222. So what we really want is, remember, this number is the 10% mark. So depending on your business decision, you want to build them up to 5% total option, 10% total option, 8%, 12%, 15%, whatever the case may be. Normally here, I would like to round it up a little bit. So in the interest of not rounding it up too much, I'm gonna say 797.22222 becomes 798. And this number is what we call the monthly option consideration now. So what's gonna happen is, I'm gonna do it this way. So in the acquisition side of things, we're gonna have the cash flow side of things, and ultimately, we also have the exit. So from an exit standpoint, we have 437,000. This is their option to purchase price, and their total option consideration is the 10% mark, which is this much, and we already wrote this out. I'm just gonna do it again so that it's very clear. That means 28,700 divided by 36 months. That means the monthly option consideration becomes 798 on a monthly basis. Okay. So once we know this, what happens now from a cash flow standpoint, because this is one of the reasons why we love this strategy so much, is because of the fact that the monthly revenue portion actually have two different components. The first one is fair market rent, and the second component is monthly option consideration. And so earlier we did say, based on the property value and the market that it's in, there is an estimate of $2,400. Now, you can make this number higher, lower, whatever the case may be, or you can even write it into your 3-year lease in this case, in terms of how you want to gradually increase that rental amount. Completely up to you. Here though, for demonstration's sake, we're just gonna keep it at $2,400 for all 3 years. And then we add the 798. So what we have in terms of a total monthly revenue is $3,198. And then we will now go into the expenses side. Because this is a rent to own or lease option, what we're really attracting are the people that will become homeowners once they hit all the lending criteria. And so what that means is it drastically reduces the need for property management and maintenance. So for the most part, most investors will budget in what we call the pity payment. Once again, such a pity that we have to pay it. So PITI, principal interest, property taxes, and property insurance. And this is also where, again, as shared with you throughout the last season and this season, we usually use the Canadian mortgage app, and also explain the difference between the Canadian mortgage calculations versus any other countries, especially compared to our friends south of the border. So right now, if you're on a desktop like I am, what you can do is you can go to Rate Hub. I'm going to write it out for you as well. .ca. Okay. So what we want to do is when you go to ratehub.ca, you're able to find out what the mortgage payment is. However, before we go there, let's just quickly come back here now. So if the purchase price, as we said, is $400,000, and we are able to do a 20% down payment, that means $80,000 in cash is the down payment that the lenders require you to have as the investor. And then what happens is when you buy a property, remember you need usually pay for appraisal, inspections, and sometimes miscellaneous items here as well. And so appraisal, let's just say an average of 500, inspection an average of 500, miscellaneous an average of 500, and don't forget, you need to pay a lawyer to help you close the deal as well. So I'm just gonna put in $2,000 here. Always like to overestimate this a little bit. And for single family homes across the country right now in Canada, $2,000 when you buy a property is usually the ballpark. If you are in different markets, just make sure that you do contact your lawyers before you put them through the conveyancing process for you, okay? So in this case, in a traditional setting, total money that you have to put into the deal to acquire the property will be all of these things added up. And so remember, one of the biggest benefits now is you actually get to pocket some money up front, which is the initial option consideration. Now, I understand that there might be some debate between accountants, between lawyers, even between lenders and mortgage brokers, especially that $15,000 should not be counted as cash flow or income. Whatever the case may be, really it is tax deferred. And I'll quickly explain that in a little bit once we finish the entire deal analysis portion. However, from a numbers perspective right now, because technically you do have $15,000 coming back, because if you were to buy this property as a regular property to hang on to, you wouldn't be pocketing the extra $15,000. So really the net total initial investment in this case is $68,500. And so if we are looking at this now, based on the $400,000 purchase, let's just say that these days, as of today, we're looking at a, say, 3-year term. Let's just go variable. I think we explained that already. As investors, a lot of the times, especially if you can already forecast the date that you're gonna let the property go, don't go into a fixed term, because the penalty for that could potentially be a lot higher if you need to break the term early for whatever reason, okay? So we're going to a 3-year term variable because it's a 3-year deal. So let's say these days we'll do 2.49%, and say you have good credit or whatever the case may be, your mortgage broker is able to get you a term for 30-year amortization. So what I'm going to do now, you know what, maybe this gives me the flexibility of switching between screens. Awesome. As you guys know, this is the second time that I'm doing it this way. So ideally this helps a lot more. So to be a lot more clear. Okay, let's do this. So this is ratehub.ca, as I wrote down for every one of you. So what you want to do now is hover over the mortgages section, and then, oopsie, you're gonna see a drop down here, and what you want to do is go to calculators and click on mortgage payment calculator. So once you get there, we can punch in the $400,000 purchase price right now, and then we're able to do 20% down. So I understand that you can see 4 different columns here. The last one already says 20%. I usually just like to change the first column to 20% anyway. And we already said that we are doing 30-year amortization, and I believe we also said 2.49. So I tend to ignore what's up here either way. I just go in and do the custom rate, because as you can see, there's a lot of good interest rate happening here. But remember, most of these rates, when they're advertising it, it's for principal residence. But when we're buying it now, it's not a principal residence, it's an income property, it's a rental property. So it's 2.49%, and you'll click on select. Now you can see at this point, a monthly payday payment, so mortgage payment, principal plus interest is $1,261. So I'm gonna stop there and come back to my little whiteboard here with you guys. So 1261 is what we have. And let's just say that this property is in a market where the monthly taxes is $350. That works out to be $4,200 a year. And then it's $100 per month on property insurance. So $1,200 a year as well. So let's add it all up. 1261 plus 350 plus 100. Oops, it didn't go. 1261 plus 350 plus 100. So now we have a total monthly expense of $1,711. Add it all up. And when you take revenue minus expenses, you have a cash flow of $1,487. Not bad at all, would you say? So to keep this going, okay, before we do our happy dance, $1,487 on a monthly basis. Don't forget, we're cash flowing that amount for 3 years, which is 36 months. So when you multiply by 36 months, you get a total of 53532. So this is the profit from cash flow that you have now. So once you are done cash flowing, guess what? Congratulations, your tenant buyers now have the credit score and the lending available to buy you out at the end of the contract. So what we're going to do now is look at what the exit is going to look like now. So your option to purchase price basically becomes the revenue at exit, because that's the amount of money they're going to pay you to buy you out. And after that, don't forget, there's still expenses regardless. The first biggest expense in this particular case is this. I'm going to stop sharing, switching back to Rate Hub, because remember, we do have a mortgage on this property. And what that means is 3 years from now, there is a balance outstanding. So we have $297,601 as the balance. Okay, 297,601. This is at the balance at the end of the 3-year term. So what we're going to do is go back now to the whiteboard again and write that amount down. So 297,601. This is your mortgage balance. And then don't forget, we still got to pay a lawyer. Even if you're a lawyer, you need to pay somebody else to do the conveyancing process for you. And then what else needs to come out? Let's not forget, one of the biggest items that we're helping them with is the total option consideration part, which turns into their down payment when they're qualified and choose to exercise their option to purchase. So what that means is, just because we did some rounding, I usually will redo the calculations once again, which is 798 times 36 months, because that's what they've been putting away on a monthly basis. We're paying you for 36 months, plus the original $15,000 that they came in with. So what we have here is 43,728. So this is their total option consideration. And last but not least, let's not forget, we need to deduct the total initial investment, which is 68,500. So let's take a look at what this looks like. 437,000 minus 297,601 minus 2,000 minus 43,728 and then minus 68,500. So what we have now is profit at closing is 25,171. I just want you to imagine this. This is the day that you get to pocket $25,000. You get to put that amount into your jean pocket, into your bank account, and you've just helped somebody or a family, better yet, become home owners through this strategy. And this is why we love the strategy. There's so many people that are involved in carrying this out that win. Ultimately, though, it is your tenant buyers that, in my opinion, that we're the most happy for, to be honest. And so last but not least, let's take a look at this. If you add up your profit from cash flow and your profit from closing in total, okay? So let's add it all up. So 25171 plus 53,532, there is a total profit of 78703. So that's your return on the entire deal. And what is the initial investment there? 68,500. So let's do that math. 68,500 and times 100%. However, over 3 years. So 38.298%. So 38.3 if you will, but let's just say 38.29% return on investment per year. So once again, just want everybody that's watching to really think about that. You get to cash flow almost $1,500 a month, and you make a total profit of nearly 80,000. At the same time, you're helping people become homeowners, helping them check off one of the most important purchases, if not the most important purchase that they otherwise would not have been able to obtain. And you're making 38.29% return on investment per year. Just think about the power of that. And so this would be the deal analysis, the numbers, and a little bit of the structure that I want to share with you on this strategy. Now, remember, in season 1, there were also 7 episodes in total created for this strategy as well. So make sure you go back and review those too. With that said, I just want to say thank you once again for following this, and I appreciate the feedback. I got some pretty decent feedback on this new format here so far, so I hope you like it, and we're saving trees, so that's awesome. With that said, thank you so much again, and make sure you share this content with anybody that you think would benefit from it, and I look forward to seeing you at the next episode. Have a great evening, everybody. Live well.